What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, happy Monday everybody, I hope you're all doing well. The outbreak in Xi'an, the worst that China has faced since the original Wuhan outbreak back in late 2019, early 2020, may be stabilizing for the first time since the strict 13 million persons lockdown was implemented 2 weeks ago, although the situation still remains critical. On New Year's Day, Saturday, new COVID-19 cases edged down slightly to 122 in Xi'an. Then on Sunday, yesterday, Xi'an's cases edged down again to only 90 on that day, at least according to official data published this morning, Monday morning. However, new cases are also being found in a few other new regions, including Zhejiang's Ningbo city and the capital of Beijing. On Sunday, it was announced that 2 more senior officials had been removed from office due to poor performance in fighting this outbreak in the city. We remember that last month, China's disciplinary body removed dozens of officials from posts in or near Xi'an for, quote, insufficient rigor in preventing and controlling the outbreak, end quote. Similar mass punishments were dished out to officials in Zhengzhou and Inner Mongolia earlier last year after similar outbreaks. This practice has been praised by some as creating strong incentives for local officials to be proactive in preventing outbreaks, but criticized by others as creating an incentive to cover up early cases or being overzealous with restrictions. Thousands of tons of food was delivered to lockdown residents over the weekend, although complaints about food shortages continue into this week. Indeed, even state media is reporting today, Monday, that residents are still facing food shortages. Millions of residents who cannot leave their homes without approval have complained about difficulties ordering necessities such as formula milk, nappies, and medicine. According to official statements published in state media, the supply of necessities has been delayed, quote, due to worker shortage, end quote. This is unsurprising considering everyone is locked in their homes at the moment. Okay, next up, the economic impact of China's zero cases policy is becoming of increasing concern to officials and analysts. In videos last week, we discussed specific economic disruptions, most notably with South Korean technology giant Samsung due to the Xi'an lockdown, but the general zero cases policy across the country comes with its own high economic cost. In a recent research note to investors from late December, Japanese bank Nomura expressed that combined with slowing export growth and a property sector crackdown with the Evergrande crisis, quote, the rising costs of the nation's zero COVID policy are creating real drags on the Chinese economy, end quote, and, quote, in our view, much more aggressive easing and stimulus measures to directly address these bottlenecks would be needed before we would see a rebound in growth, end quote. In an effort to slow the rapid exodus of foreigners leaving China, over the weekend, China's Ministry of Finance and the State Taxation Administration announced an extension to tax exemptions for foreign expatriates' fringe benefits by 1 more year. This announcement is part of China's recently released tax relief measures for tens of millions of Chinese residents in an effort to boost domestic spending. The taxation authority last week said some personal tax income breaks will be extended into the new year, and preferential taxes on year-end bonuses will also stay in place until the end of 2023. Some business groups had warned that the imminent termination of tax breaks for expatriates might lead to an exodus of top talent due to rising living costs. One of the other factors behind people leaving is concern regarding an increasingly unfriendly environment towards foreigners, however, something a modest tax break would do little to remedy. But also the very tight travel restrictions is a key factor behind international talent retention issues in China too. In September, a survey released by the American Chamber of Commerce in Shanghai found that a whopping 53% of companies said COVID-related travel restrictions had, quote, hurt their ability to attract and retain foreign talent, end quote. Indeed, 45.1% of respondents said, quote, COVID-related restrictions had negatively affected their operations, end quote. Then last month in December, the British Chamber of Commerce published a similar survey which showed that 41% of British businesses in China, quote, expected a significant number of their foreign employees to leave China indefinitely, end quote, with the most common reasons why related to border restrictions. And over the weekend, Vietnam's trade ministry told Chinese officials that China's tight border controls in response to COVID were, quote-unquote, overkill, which is seriously hurting bilateral trade and damaging local economies at the border. Quote, pandemic prevention measures that Guangxi is applying under the zero-COVID policy, such as stopping border gate operations or stopping the impact of some types of fruit, are overkill. This disrupts supply chains, negatively impacts the development of bilateral trade, and causes great losses to businesses and people on both sides, end quote. Indeed, over the last few weeks, as both countries have seen outbreaks, the Chinese side has further tightened already incredibly strict border controls. For example, on December the 21st, only a few weeks ago, a major border city in Guangxi announced that it had temporarily stopped clearing cargo to pass through its port of entry. A few days later, on the 25th, another major port border town in Yunnan province did the same. Now, before we move on, there is one miscellaneous development that doesn't really fit into some of these other developments, but I wanted to include it here and cover it with you guys quickly. According to the Chinese financial media outlet Caixin Media, Beijing is to fast-track unified export control lists for weapons tech. Quote, China outlined its commitment to export controls aimed at preventing the proliferation of nuclear weapons and other military technology in its first white paper on the subject. Beijing also vowed to fast-track the drafting of a comprehensive list of items prohibited from sale overseas, end quote. The State Council, the nation's cabinet, published the white paper to, quote, provide a full picture of China's policies on export controls and to help the international community better understand China's position, end quote. I think there is more to the story and we'll be following it closely in the future. Last up, Evergrande is not having a happy new year. Only 3 days into 2022, and Evergrande is having a lot of bad news. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. Over the weekend, the local government in Danzhou, a prefecture-level city in the southern Chinese province of Hainan, demanded that Evergrande had to demolish 39 buildings within 10 days because the building permit had been, quote, illegally obtained, end quote, a sign, among other things, that Evergrande is fast losing its political connections, like rats from a sinking ship, as one netizen online referred to it as. On Monday morning, Evergrande suspended trading in Hong Kong, quote, pending the release of inside information, end quote. The company did not elaborate what they meant by this, however. And incredibly, according to data tracked by Citigroup analysts, Evergrande saw its December sales fall 99% year on year, the worst performance of any major Chinese developer, followed by the index. Meanwhile, this morning too, shares in Shimao Group Holdings, another troubled developer that we have been following closely over the last few months, dropped almost 6% to their lowest point since March 2019. The drop was likely in response to data published by China Real Estate Information Corp, which showed that Shimao missed its already lowered 290 billion RMB sales guidance for 2021 by 7%, with December's sales collapsing 68% year on year. In a research note published today, Monday, Bloomberg intelligence analysts observed, quote, risks to Shimao's liquidity could extend into 2022 as a parade of unfavorable media headlines threatens to keep potential buyers at a distance, end quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.